everybody. My name is Paul Johnson. I've been doing this a while. So this is kind of what you need to know about equity term sheets, early stage financing, essentially. And as Teresa said, there's kind of two parts to the presentation. The first part is about safes and notes, which is what most entrepreneurs will face first. And more entrepreneurs deal with that than do eventually deal with a Series A, which is part two of the presentation. Series A or preferred stock financing is substantially more complicated, so there's more to talk about there. But as Teresa said, I'm going to pause after the part about notes and safes because it may be what is more likely to be in front of you. So convertible debt. This was kind of the old school way of raising money when you weren't ready to do a priced equity round or Series A round or even a Series Seed round. Series Seed is kind of a new nomenclature. It wasn't around when I started my practice, but in any event, convertible debt. So what does that mean? Or why would you use convertible debt instead of a preferred round? It's quicker. Preferred round has a lot of documents. We're going to talk about those in the second half of the presentation. Like I said, it's more complicated. So convertible debt doesn't have all that stuff. Convertible debt, there's really usually one document. Sometimes there's two, a purchase agreement and the note, but a lot of times you can get away with just the note, particularly if you're dealing with one person. You don't need a separate purchase agreement. Term sheets are shorter, the documents are shorter, it's more efficient. And when I say more efficient, what I typically mean in this context is you have to pay me for less of my time. You have less legal involvement, which is cheaper for you, which is good. And it's also cheaper for you because usually investors, they need a lawyer as well. And a lot of times the investor will ask the company, the issuer, to pay for their legal fees. And so you're paying two lawyers to work on a deal when you're raising equity. So if you can do it more efficiently, you're doubly more efficient in this context. So debt is pretty attractive for the entrepreneur. Why is it so much more efficient? The big one is that you're punting on one of the key questions. You're not addressing this question now, and that is a price per share. So what is this company really worth? If you're investing in a convertible note, you don't need to have an answer to that question. I'll tell you why in a second. Also, because it's a note, it's debt. The person is actually loaning you money, and they expect to get repaid. Because it's debt, under the laws of the US, it sits on the top of the stack if there's anything bad that happens to the company. So it's built-in downside protection. In other words, if the company goes under, the debt holders are the ones who are first in line to get their money back. Now, in a typical startup, there's probably not much money to get back, but for what is there, you're at the top of the heap. And it's the convertible note, because it's convertible into equity, it has upside in that converts into that equity that is hopefully increasing in value. That's the whole hope. You give the company money, they use it, they make their company more valuable, and then the investor can get something more out of it. So what are typical convertible debt terms? Number one, of course, is how much money. The note has to have an amount at the top. There's usually an interest rate, but it's also kind of a secondary consideration. Usually people are not giving startups money to make some interest rate. They're making it because they think the startup's going to blow up and make lots and lots of money. It's going to be the next Google, Facebook, whatever. And so they want to make the money on investing in that in the early stages. So interest rate's usually a secondary consideration. But there's a maturity date, meaning that the startup has to pay the money back at some point. It can be a year, it can be 2 years, 3 years. There can be complications with longer terms, but there is a maturity date. Money has to be paid back at some point under a note. Otherwise, it's not a note. It may or may not be secured, meaning like your house, the loan you got on your house is secured by the house. Bank can take your house back. The loan on your car typically is secured. Bank can take your car if you don't make the payment. But most notes to startups are not secured because what would they take back? If a startup is failing, what are you going to look at as a note holder and take and turn into anything liquid? There's nothing there really. So by and large, these notes are unsecured. But they do convert, like I said. The amount of money that is loaned to you under these notes will convert in a financing or a sale at some price that's determined in the future. And the determined in the future part is the part that's the punting on the valuation. How much is the price per share when you get a convertible note? You don't know. So someone gives you $100,000. How many shares of your company is that going to be? You don't know, nor does the investor. And that's on purpose, because figuring that out would take a lot of time and effort and diligence and probably expertise that this investor may not have. Some do. If you're dealing with a VC, who is giving you a note, they very well may have the expertise. They do have the expertise to figure it out. But if you're dealing with angel investors, they may not have the resources to feel comfortable in coming up with that. So what happens? That note will convert in a qualified round, which means a round of financing of at least a certain size. So if you raise $150,000 from your sister-in-law in the future, that is not going to be enough typically to convert a note. Typically, note rounds are in the hundreds of thousands of dollars. They can be in the millions of dollars in terms of how much money you receive. But then they're looking usually for a round in the millions of dollars, 3, 5, 7, 20, whatever it is. But before the note is going to convert, they want to make sure that you're raising enough equity to where this is a real round. So they call that the qualified round. And the money that's given to you in the note usually converts at some sort of discount, meaning if someone gave you $100,000 and the price of the Series A that you're converting them into would otherwise be $1, it'd be 100,000 shares. They get a discount. So instead of $1, they convert it, say, 80 cents a share. So you divide 100,000 by 80 cents. And I can't do that math in my head. I'm a lawyer, but it's more than 100,000 shares. That's how the discount works. They get more shares, and that compensates them for the risk they took in investing in you before anyone knew what you were worth. And that's the whole thought here. It's like, hey, these people are giving you money early. It's going to turn into equity at some point when you have a real equity round, but they're going to get something for doing that for you. Another trigger for conversion or payback would be a liquidation or sale of the company. So let's say that happens before you raise an equity round. No qualified round has happened yet, but you end up selling the company at an attractive valuation. The note may say that the amounts in the note convert into some new form of stock that's created at the time. That's challenging from a legal perspective because you have to define what that is now before you really know the facts. So that's tough. I don't like that. It can convert into a pre-existing form of stock. If you have a preferred round you've done already, you can have a convertible note in between your A and your B. And maybe if you sell before the B, your note will convert into A. That's not a bad solution. But if this is really a seed round, there is no pre-existing round of preferred. Will it convert into common? That can be kind of dilutive. So that's not awesome for founders. But here's another alternative is sometimes it's paid at a multiple, meaning I put in $100,000, you're going to pay me 200 on a sale or 300. So definitely a return, 1 to 200% return. If there's a sale, then that might be actually less dilutive to the founders than converting into common. So those are kind of the main terms for a convertible note. I'm going to pause there. This is one place we may want to allow you to ask questions. Anybody have any questions about using convertible notes?
I just have a quick question because I get this all the time from entrepreneurs. Hi, Paul. You probably recognize me. I'm actually Charlotte Triplett from ULP. But my question is, why is it that a lot of angel groups only prefer convertible notes over safes? Can you give any context around that, or why you think that may be?
Yeah, so we'll talk about what safes are in a minute, but there's a little bit more to control in a note, I guess. The safe, as you know, is something that you usually print off the internet from Y Combinator, that they invented it. And it's intended to be, it was intended to be, it hasn't turned out to be this way, but it was intended to be something that could be very efficient, very little legal time, very little negotiation, and that's kind of where people land. Angel investors have realized that it doesn't really give them as much control over the business, as much influence, or as much of a return as they would like. And so they've kind of reverted back to notes where they get some of that control. Now you can kind of jam that into a safe if you want and negotiate it, but since the safe was intended to be a kind of print it and use it, it's not what it was intended to do. So it really comes down to return and control is what it is. Any other questions about notes? If not, I'll jump into safes. All right, we'll jump then. So safes, what is a safe? There are different flavors. There used to be something called a KISS, which was a keep it simple security. And that fell into disfavor as everyone started to use safes. The actual safe stands for simple agreement for future equity. That's a safe. It was invented by Y Combinator, who is an accelerator up in the Bay Area, and I think they've got maybe more now. The form's on their website. You can print it, you can fill in the blanks, and you can use it, though I don't recommend that. Um, it was based on notes originally, meaning it's kind of the same concept as a note, but there's no maturity date and no interest. So would an investor care about that? Maybe. Would that be one of the differences that an investor likes in a note, that there's a maturity date? Yeah, quite possibly. Like if there's nothing that happens in 2 years, then the investor can come around and say, hey, my note's due. What are we going to do about it? That's kind of one of the problems actually with the notes, though. From a founder's perspective, if you have a note that says you owe this person $100,000 and you don't have $100,000, they can take you to court. They can sue you. They can foreclose on your assets, even if it's unsecured. You owe them that money. It's real. And so that was a challenge with convertible notes. That gives the investor more control. So maybe investors like that. The other one is interest rate. If, like I said before, the interest rate wasn't a key concern, Y Combinator said, well, why even bother with it? It's not that important. I have seen safes where the investors have gone back in and added an interest rate. I've only seen it from one investor. So I don't think it's very widely done. It can be done, but most safes are just, hey, you put your money in, you give the company your $100,000, and it's, as this last bullet says, it's a placeholder for investment in a future round. And it will convert with a discount and or a cap. So safe, like a note, but no maturity date. The money just sits there, meaning that the instrument sits there. A company can take the money and can spend it, but it doesn't owe it back at any particular time, nor is it accruing interest. So why is that better? Same as the note. There's no valuation discussion in theory. We'll talk about that in a second. And advantages, no interest, no maturity. But like I said, in answering Charlotte's question, the idea originally was it was supposed to be a simple form with no negotiation, but that is not kind of how it's turned out. You end up talking about it, you end up negotiating it, you end up negotiating. There's now a side letter you can do that goes with the safe. A lot of investors who take safes, they want more added to them. One other challenge with them is they were intended to really be a standalone instrument, meaning it only provides for one investor to sign a safe. So if you want to issue safes to 10 investors, you can be printing off 10 of these, and each of them are individual. You have to modify them to make sure that they all can act together. And a company wants that to be the case. So now you got to get a lawyer involved. This isn't the end of the world. I like lawyers, but it costs a little bit of money. So you're no longer off the shelf. The other thing to have in mind when you think about from a company's standpoint is Y Combinator is an investor. They have investors' interests in mind, and so their forms are a little bit more investor centric. Another thing to think about is, what's this cap idea? The cap is,
Did you just say that safes are more investor centric?
yeah, they are.
That's the first time I've ever
Well,
heard that. So I just was very
they
curious
were,
if
well,
that's
the post money safe is definitely more, and
okay.
I'm going to get to that.
Okay.
Even saying that though, I realize that angels now are trying to get you to use the notes, and I think they have more control, like I said. But a safe is, well, going back to just what is a cap? A cap is an attempt to set a limit on what that conversion price is for the equity that was invested. You can have a cap in a note too. You can have a cap in a safe. All that is doing is, you remember my example where I said, oh, the Series A is $1, but the note has a discount for 20%, so that's going to convert at 80 cents. Same theory applies in a safe, but under a cap, you'd say, well, shoot, this company, most I would pay for it today, the highest valuation I would give this company today is $5 million. What happens if they raise money at $50 million? But it's probably my money as an investor that got them from 5 to 50. Shouldn't I share in that upside? And if that's now $10 a share instead of $1 a share, my discount would only allow me to get shares at $8 instead of $10. Like, wait, why don't we set a cap? A cap would say, at no point will we convert at a price per share than what would have been calculated if the value was 5 million. 5 million, if you have 10 million shares outstanding, is 50 cents a share. So now I'm converting at 50 cents instead of $10. I like that better as an investor, so I like a cap. That's what a cap is. And so is that a valuation? Not exactly. You're not saying the company is worth $5 million today. You don't know what it's worth, and that's the point. But you are saying, I wouldn't pay any more today than $5 million. So is it a valuation? Kind of, in some sense. You're not worth more than that to this investor. So how does a cap work? Well, it puts a cap on it, which means it can be pretty dilutive. But most investors will insist on that. So now we get to what's a pre-money versus a post-money save. When Y Combinator started, they used what's called a pre-money save. But as they went along, they realized that investors were not happy with what a pre-money save did. A pre-money safe didn't give the investor any visibility into the percentage of the company they were going to own. Remember when I said about the notes that you don't know today what you're going to get? That's what the safe was doing too. So Y Combinator said, well, let's change that around. Let's instead say, if you end up converting into the cap, that the cap is a post-money number, which means that if you give me $100,000 and the post money cap is 10 million, that's 1%. I'm going to say I'm going to own 1% of this company even after the financing is done. Investors happy, they know I get 1% of this company regardless. If it sells at 50 million or 500 million, I still get 1% of the company. That's awesome for the investor, lots of visibility. For the founder, that's okay if you are okay with that, number one. And number two, if you think about it for a moment, as a founder, you issued 10 of those. And now you got a collection of safe holders who are guaranteed 10% of the company on a financing. When an investor shows up, a Series A investor shows up, they're also going to have in their mind what percentage of the company they want to own, say 30%. So at the end of the day, they're going to own 30. The safe holders are going to own 10. That leaves the founders with 60. And so you're going to be potentially diluted at 1% for each one of those safes you issue, and it's going to come out of you. It's not coming out of the Series A investor. So if you issue a lot of safes, a lot of post-money safes, it can actually be significantly more dilutive to you than a pre-money safe, the way this calculation works, because the safe holder is guaranteed a certain percentage of the company. So the way that works is the post-money, the safes themselves are in the denominator and calculating that price per share, diluting founders. This is, and I don't want to denigrate either Y Combinator or the use of post-money safes. They're great tools. They are much more efficient than a Series A financing, and they're probably, unless you're dealing with someone that wants a note or safe is most likely what you're going to be dealing with as an early stage company, as opposed to a priced round. So they're good tools, and they're worth using, but don't just print the one off the Y Combinator website and use it. You need to understand what it says and how it's going to affect you, and it is meaningful. So I'm going to pause there and kind of go back to the notes versus safes conversation. There's I think it's the Angel Capital Association now has a form of note that they suggest you use instead of a safe. The big difference I saw when I looked at that, it was control. They were asking for things like participation rights, voting, maybe a board representative, maybe board observer rights, that sort of thing kind of works its way into those documents. And then I don't remember that there being any sort of advantage on conversion. So I don't know that economically there was a huge difference. But I will say I have heard and read articles online about investors grumbling that the return they get using a safe is just not enough. And so that's what led to this post-money safe. The investors were saying, look, you used my money and got to some huge valuation. I should be getting more of that than I was getting under a pre-money safe. But just be very aware. They can be dilutive if you start using them a lot. Kind of a pro tip, if you add the amount of money you raised in safes to the post-money cap, if the safe says that, you actually undo that dilutive effect. So that's where having a good lawyer can help you.
Can you, sorry, could you just clarify that a little bit with an example?
Yeah,
Like, for example,
the way the math works out is, since you're throwing the safes in the denominator, the safes themselves are in the denominator and calculating that price per share. If you add them to the numerator too, Like your valuation is, say it was 10 million, but you raised a million on safes. And if your safe says, all right, it's 10 million plus the amount raised by safes, okay, well now it's 11 million. It essentially washes out.
So that's what I was going to ask because my understanding is most people who raise on post money safes, like say your target cap is 10, like you're raising 2 million, your implied valuation is sort of 8 at the time, and the post money valuation is 10, right? Is that what you're saying? Is
That's
that
what
the
you'd
same
want
way
to
to?
do. You want to
Yeah.
make
Okay.
sure that if
Yeah.
someone's saying to you, I want a cap at 8, and you know you want to raise 2 million safes, I'd say 10. The
So
problem
what I
is,
hear the danger is from you is that if they don't close that round with the amount of money that they think they're going to be further diluted than they had hoped at that.
yeah, this presumes that you know how much you're going to raise. And unfortunately for startups, they don't, right?
Yeah.
You get one or two people and you get a couple 100,000, and then 3 months later, it's not unusual for me to get a call from my client saying, "Hey, I got a couple more people that want to put in a couple $100,000 more." Like, okay, wait, we thought it was 200 before the cap had that amount. Now we're going to adjust it. Like, so you go out.
That just brings up such a great point. Can you talk about what happens when you oversubscribe? Because like that happens a fair amount. Is it impossible then to oversubscribe a post money safe?
Um, Oversubscribe. Well, essentially, if you haven't built it into the cap, you're gonna have to go back and talk to all the other people and get their cap changed, unless it's automatic, right? And that's one thing where, again, a safe is, like I said before, it's a one-off instrument. It's not really intended to be gathered into one place and used. Like you can have like I said with notes, you can have a note purchase agreement. The purpose of a note purchase agreement is all of the purchasers sign that document, and then they all get a note that's issued under that document. You could do the same thing with a safe and have a safe purchase agreement. Look a lot like a note purchase agreement. And that way everyone's clearly part of one round. And then
Hmm.
one of the big things that's in those agreements is it says holders of a majority of the money, the investors of a majority of the money can amend the note, can amend the note purchase agreement. And you could say, and we do say this in safes too, holders of a majority of the safes can amend the safes. Well, what are the safes? That's the problem. Like without a safe purchase agreement, how do we know what the safes are? And so we say in the safe, well, if this safe looks like another safe that we issued later, they're all part of the same thing and they're all the safes. Does that really work? If someone sued on that and said, I didn't realize that this guy down the street bought a safe. The company sold safes before me and after me. Yeah, the safe said it was part of a group, but how do I know who's in the group and who's out? And I therefore refuse to accept this amendment that the company wants to push on me without my consent. So a safe gets you to the place like as a one-off instrument means if you want to amend 10 safes, the best solution is go talk to all 10 investors, which now is problematic, right? Can you get 10 people to agree to anything? That's hard. You sit around the Thanksgiving table with your family, you're not going to get 10 people to agree on anything. Everyone knows what that dynamic is like. And so you get more people that statistically there's going to be an outlier and maybe two, right? So you're going to have one person that just doesn't understand, doesn't want to deal with an amendment of the safe. So that's where it gets challenging. But you can, yeah, you can. So does it mean you can oversubscribe? You have to have some visibility into what you think is going to be the case. I think it wouldn't be a problem for you as the issuer to say, hey, it's $1 million safe round, and then you end at 500. That just means your cap's a little bit higher than you thought it would have been otherwise. That's okay for you. Higher cap is better for you. For the investor, it's not so good.
Thank
But
you.
now you thought you're going to raise 1 million and you raised 4 million. You gotta be thinking about before you go, but from the 1 million that was in your cap to 4, you need to be thinking about it. It just means it's going to be more dilutive to you. But most founders are like, hey, I'll take the money. I need the money now. So are we good there for safes
I
versus?
think I was just going to ask the question because what I'm hearing you say is that only concerns post-money safes, not pre-money safes, like in
Yeah,
terms
that's
of
right.
renegotiating. Okay.
Yeah,
Thank
that's
you
right.
for that
Yeah,
clarification.
and I still get investors that are willing to accept a pre-money safe.
I see it a lot.
Yeah.
It's not an issue. Typically, if they're going to do safes, they it's not as much. I do see a lot of angel groups though, like I said, saying we want to have notes, like we don't.
Yeah.
It's,
Yeah.
yeah.
All right, so we're a half hour into the presentation, and what's next is probably an hour's worth of material. So I'm going to probably move quickly. Um, this is moving into priced rounds. Is there a middle ground in terms of complexity between safes and like say the NVCA documents? So what's the NVCA documents? NVCA have become essentially the standard for Series A. The NVCA is the National Venture Capital Association. They came out with 15 plus years ago a set of documents that were suggested to be used as a Series A set. They have become kind of the standard. All lawyers know what they are. We run red lines against the series or the NVCA documents when we get something from opposing counsel to see what's different. So they are the standards, but they are investor friendly. NVCA, National Venture Capital Association, they are a group that's intended to protect the interests of investors. And so these are investor friendly documents. Is there something that's between those and notes and safes in terms of complexity and company friendliness? Yes, there is something. There's something called a Series Seed. There may be others. Series Seed is, I actually really like it. The problem is it hasn't been updated. It's like an open source document. It hasn't been updated for 11 years. If you go to seriesseed.org, I think is what it's called, online, you can find it. Pretty elegant. It's got a term sheet and like one master purchase agreement with some basic rights built in, and then a certificate of incorporation. Pretty simple. The way it gets away, the way it makes it simpler is it punts again on one of the questions. It's instead of negotiating all the rights that the NVCA wants for its members, it says we're not going to give you registration rights. We're not going to give you some of these other rights. But if someone comes along later and negotiates for those rights, then the Series Seed investors will get those too. Most favored nation clause. So you don't have to negotiate all the documents. It gets down to maybe 20, 30 pages of documentation instead of 80 to 100 pages of documentation. But you do need evaluation, unlike notes and safes, and you still need to know what you're doing. I just want to throw that out there. It exists. I like it, but last time I proposed using it, last two times actually, I proposed using it for a company. The investor said no. One because it was too old, and the next one was because no, they wanted more rights. So what's the NVCA form? What is this about? This is now we're getting into true terms of a preferred round Series A. Talk about the term sheet first. And this is probably the most valuable part. So the terms in the term sheets are mostly non-binding. And the closing is subject to completion by the investors of due diligence. So when you sign it, it's an intent to invest, but it is not an actual investment. But it does set expectations. It sets a valuation. The pre-money is the value of the company before the investment. The post-money is the value of the company after that investment. So you say, oh, I got a 10 million pre-money, I'm taking 2 million, and therefore I have a 12 million post-money. That's how that works. The term sheet will tell you who's buying, they're buying how much, what the security they're buying, typically Series A. Sometimes we call it Series Seed if it's really early stage. You can call it whatever you want. Series X, whatever. The name is not that important. What's important is the terms. It sets the price per share, which is the valuation divided by the number of shares. So I'll talk more about that in a minute. It may set terms like how many tranches there are, how many closings you're going to get. Not unusual for an early stage venture investor to say, okay, fine, I'll give you 2 million today. And then if you do okay with my 2 million, I'll give you another 3 million later. So a couple of different tranches, there may be a milestone to be met between tranches 1 and 2. Typically, it also asks for an option plan adoption or expansion. The reason for that is many early stage companies need to use options. They don't have enough cash to pay their people what those people would make at other large companies. And so people working for startups expect, notwithstanding the low pay, to get an option to compensate them. And investors realize this. And so since that's going to dilute them giving away equity, they want the founder to suffer that dilution first. So they will insist that you adopt or increase the size of your option plan before they invest, and they will calculate their price per share, assuming that increase has occurred. Typically, it's a convertible preferred. What does preferred mean? Preferred is there's a preference entitled to a liquidation preference, which is a downside protection. We'll talk about that in a minute. But it also converts to common, which is where the upside is. So it's kind of a straddle between a note, which is purely downside protection, with conversion to something it's not a note, not as onerous on the downside, but it has downside protection and has upside. Also be aware that selling common stock, if you were to sell common stock instead of preferred, that can cause issues for your options later, because typically you set a price, right? You sell your common at $5 a share. Well, now your options, which are options to buy a common stock, they'd have to be priced at about $5 a share, or there can be tax issues. So we'll talk about that more in a bit. Rule of thumb is, at least theoretically, only raise the money you need to get to the next stage. You're always raising money in the worst possible position. When you're raising equity, if you could just get 100,000 in today and increase the value of your company by $500,000, that's what you should do. Of course, though, that presumes you know how much money you would need and how much money you would increase the value, and that's really hard. So no one ever goes bankrupt by raising too much equity, but at least in theory, you should only be raising what you need to get to the next level. So let's see. I will pause there because this is another natural place to ask questions. Anybody have any questions about this?
I put one in the chat, Paul.
Okay, let's see. I have to exit full screen, I think, to look at.
Sorry, I can just ask it if
Go
that's
ahead.
easier for you. I was just asking why an investor would want common stock. Doesn't that kick them out of the preferred line? If the exit isn't that great, then they're last in line. It
Yeah,
doesn't seem to make sense to me why they would want that. I
it doesn't,
wondered.
but you get angel investors who don't know better, who say, "Oh, I don't care what I get. Yeah, give me common, whatever." And
Okay.
and if they're willing to be on the same level, that's fine, but it does create a problem for the company too.
And doesn't it create different tax implications, like you mentioned, for the investors? Okay.
Well, I mean, principally for the company, and for option holders. Like,
Okay.
if you issue preferred at $1 a share, this is not true anymore, but back in the old days, we used to say the common's worth 10% of what the preferred is. So preferred at $1, you could price your options at 10 cents, and that would be deemed fair. Again, that's not how it works today, but it gives you an idea that preferred is worth something more than the common, which
Yeah.
means that if you sell a common, you've now set,
You've priced it, and
yeah,
then
you've
everyone else
priced
is,
what the
yeah,
common is
I
worth.
see what you're saying.
And then therefore, you know what the fair market value of the common is, and stock options are supposed to be priced at fair market value or there's a tax problem. So now you have to issue options at $1 a share if you sold common at $1 a share, and it's not as enticing for the recipient. If you can give it to them for a dime, they'd rather have that. Now you may say to yourself, well, I'd rather sell them shares at $1 than a dime. Yes, that's true, but you're not really talking large amounts. And the reason you give an option is to provide incentive for the employees to build value in your stock. And so I don't look at that delta as being helpful to the company. And no one ever exercises options either. Like, that's just a dirty little secret. I mean, probably 10% of the options I've ever seen issued, probably not even 10%, have ever been exercised. So the company doesn't actually get that cash. What
Right.
happens
They're not gonna.
is company
They usually,
sells later and the options are cashed out.
yeah.
So pricing an option at $1 isn't really helpful to the company versus 10 cents.
Thank you for that clarification. That was helpful.
All right, so there are some binding provisions in term sheets. I'll just kind of go over this quickly. Exclusivity, you can't take the term sheet and market it to another VC down the road. Confidentiality, same idea. You're not going to go share the terms of the term sheet with a bunch of other people. Sometimes expenses of counsel are in there, usually not. Sometimes, well, a lot of times there's an expiration date that says if you don't accept it by such and such a date, it expires. That is rarely meaningful. I'll get a client that comes to me and says, "Oh, this expires by Friday. If we don't respond, don't worry about it." The investor just wants to make sure that they want to talk to you earlier, and you can't wait 6 months and come around and wave this term sheet in their face. So just because it says it expires Friday doesn't mean they're going to stop talking to you on Friday. All right, so overview of the non-binding terms and where they end up. The non-binding terms and term sheet end up in 5 different documents. Remember I said that these are less efficient legally? That's because you got 5 documents that are like 20 pages in length, as opposed to a SAFE, which is like 7 or 8 pages in length. So you're paying a lawyer to negotiate, draft, and make sure everything is grammatically correct. All periods are in the right places. All semicolons are in the appropriate places. All that, you're paying a lawyer to deal with that in 100 pages of documents instead of 7 or 8 pages of documents. So that's why it's a lot more efficient to do a SAFE. Here are the documents. Certificate of Incorporation. You heard me mention that before. That is the document. It gets filed with the state of incorporation, Delaware, California, wherever you've been formed, and it creates the stock that's being sold. You say in that document that's filed with the state, we have Series A stock and we have this many shares, and here are its rights. And so what are its rights? We'll talk about those more later, but Liquidation preference I mentioned, there's voting rights, there's dividends, potentially maybe redemption, other rights that they are all set forth in the certificate of incorporation. So that contains actually most of what's in the term sheet ends up in this document. The next document is the stock purchase agreement. And that's all the logistics. That's when we're going to have a closing. How much is going to be sold? What are the conditions that have to be met before the investor will give you the money? Those are all in the stock purchase agreement. Investor rights agreement. These are other rights that the shareholders are asking for, the Series A investors are asking for, but that are not tied to the stock itself. They're not a right of the Series A in the same way. Like, oh, you're going to agree to register these shares with the SEC. That's contractual. That goes in the investor rights agreement. Oh, the investor wants the right to buy their pro rata share of the next financing. That could go in the certificate. You don't want it to, so it goes in the investor rights agreement instead. Voting agreement. This is the document that sets the board size. One of the things a Series A investor, VCs in particular, are keen on is making sure they have representation on the board. So this is what's going to guarantee them that. It's going to set what the board size is, who is on it. And typically there's also a drag along that drags along minority players if the company ever gets sold. And finally, there's something called the right of first refusal and co-sale agreement, which are limits on the founder's ability to sell the shares they already have. One bit of a pro tip here is it may not seem like that big of a deal to give a right in the Series A, but if you give it to the Series A, you're never going to get it back. So if your Series A investor is asking for something that feels a little bit uncomfortable, realize you're going to be giving that not only the Series A, but the Series B and the Series C most likely too, unless you are just that good of a company where you can command all your terms. And many companies are not in that position. So on to what's in the certificate of incorporation. This we're going to really have to fly. We've got 18 minutes and 22 slides. We're probably not going to get to them all, but I'll just give you a little bit of an overview. Dividends, they're in the certificate of incorporation, largely irrelevant. I've never seen a startup pay dividends, but it's negotiated every time. So, all right, it's there, but we're not going to worry about it. The only time I get worried about it is if the term sheet says it's a cumulative dividend, which acts like interest, meaning it's accruing interest over time. And I would just say you don't want that. The regular term that's agreed to here is dividends are paid if the board ever feels like it. So next one, and this is the big one. The main right of the Series A preferred is its liquidation preference. Its right to get its money back before the common gets its money back. Now it sits after debt, but before the common, it's equity. So if you're a company and you are talking about what would you rather have, I'd rather sell priced preferred for this reason than get a note, even though the note's more efficient. Another thing is you get too many notes or too many safes, and at some point it's going to be very complicated to convert them into equity. So if I had my druthers, and it's not because people have to pay me more for it, I would rather have a priced round as the attorney. It makes my life simpler. So liquidation preference, again, right to get their money back. Usually it's 1x, meaning they just get their money back. In really uncertain times, we saw this jump up, like in 2008, when the economy was falling apart, many VCs just weren't investing at all. And if they were investing, they were saying, hey, look, I need to get a guarantee of 2 or 3x my money back, not just 1x. But that's only in really difficult, uncertain times that happens. Most time it's 1x. There's also something called participating versus non-participating. This is a key term. Participating preferred means that the preferred gets their money back and then they participate along with the common. So in other words, they give you $1 million, they get their $1 million back, and then you're going to pay them the same amount the common gets on a per share basis. So they're always going to be better than non-participating, which is they just get their money back. I fight that. We usually win, but not always. The reason we fight it is because participating is always better for the investor. And if you give that in a Series A, it's going to be really hard for you to not give that to Series B and Series C as well. So now you really are diluting yourself. So I try and insist on non-participating preferred. If you do have to give participating preferred, you can cap it, as this kind of final bullet says down here, but that's not an ideal situation either. Other rights in the certificate, voting rights, that says the Series A votes along with the common on an as converted basis, which is typically 1-to-1. The Series A also usually gets a separate vote or veto on a number of things like changes to its rights. Legally, they get that, whether it's in the certificate or not. They usually will elect one or more board members. We'll talk about that in a minute. And then they have a number of protective provisions, which are controls over the business that will get heavily negotiated, stuff that you can't do without their permission. So this is, everyone hears about, oh, VCs, they just want to take over the business. Yeah, they would rather have more control than less. How do they do that? They do it by getting a board seat, which they typically don't control, but they have significant influence. And then they get these protected provisions, the list of stuff you can't do without their consent. So board constitution, like I said, this is where control is really exercised over a company. Majority rule. So if you have a board of 3 people and the VC has 1, you still theoretically have 2. You can outvote the VC. But many VC term sheets say that they're going to have 1 seat on a 3-person board, and then an independent board member is the second one, and then the founder is the third one. So it's kind of evenly split. So the most rational decision theoretically is made, as which may be against the interest of the VC or against the interest of the founder. That's kind of TBD, but that's a very typical arrangement. Or a board of 5, 2, 2, and 1, 2 representing the investor, 2 representing the founders, and 1 representing being independent. You always want an odd number. Even numbers, you end up with deadlocks, and companies die that way. This is in the certificate. How many directors are elected by the common in the Series A or in the certificate of incorporation? Who actually has the right to appoint the designee that's elected by the Series A is typically in the voting area. So here's some protective provisions. Again, being short on time, I don't want to dive into these, but I want you to look at these and see these are the sorts of things investors may tell you you can't do without their consent. Can't sell the company, can't amend your certificate, which means you can't issue a Series B without their consent. You can't create more common or preferred or more Series A. In other words, you can't sell more Series A to someone they've never heard of without their consent. You can't do a Series B without their consent. You can't incur a lot of times a material amount of debt. In other words, any new influx of money has to have their consent. That, because they control the purse strings, is a lot of control. So just FYI, these are typical provisions. We push back on these. We win sometimes, we lose a lot of times on these because investors really want to have control. Conversion, I talked before about how these preferred shares, they convert into common. Similar mechanic as safes and convertible notes. There's a formula that sets the conversion amount. Typically, it starts at 1-to-1. Each share of preferred converts into 1 share of common. That makes it simple for tracking your cap table. The last bullet on this page is talking about what we talked about before. The preferences that the preferred have, plus this conversion right, means that this preferred is more valuable than common stock, which means you can have a difference between its price and the common stock, which allows you to price your options in an advantageous way. A little more on conversion. The preferred will automatically convert in certain events, like an IPO, sometimes sell the business, or they can be forced to convert if a majority convert. That's to kind of clean things up. If the largest investor feels like it's the right thing to do to convert from preferred to common, they can force everyone else to, and that's good for the company. Antedilution, you probably heard what antedilution means, or you've heard about it. What antedilution means is you change that 1-to-1 ratio. Conversion is based on that formula, like I said, usually 1-to-1, but let's say you do a stock split, and now you do a 1-for-1 split of the common. So now there's twice as many shares of common. If the preferred still converted at 1-to-1, that wouldn't be right. And so you change that formula to reflect that. Stock splits work the same way. They're formulaically changing. You formulaically change the conversion ratio. But there's something else called price-based antedilution, which is what happens if you sell stock at a lower price than you originally sold to the Series A. Arguably, the value of the company has gone down, or you overrepresented what the company was worth at the time you sold it. In either event, the Series A is interested in having more of the company than they got for their money. And how do you do that? You adjust their conversion ratio. And there's a formula. It actually it sounds simple, but it gets to be complicated in practice on how that's adjusted. Talk about it's here in the second bullet. There's 3 types of price-based antedilution. The one that everyone uses is the first one, broad-based weighted average. And that takes into account how many shares are being sold at a cheaper price, how many shares are outstanding. So what's the proportionate reflection of the decrease in value of the stock And that's this A plus B over A plus C formula. Won't dive into the details, but what that does is it tries to adjust the conversion ratio in a way that takes a number of factors into account. Bottom line is you never want to get here. You never want to have to sell shares at a cheaper amount than you sold at the Series A. And even if you do, we typically go back to the Series A and ask them to waive this. Now, not everyone does. And when they don't, things get really complicated really fast. But we do ask them to waive that. Sometimes there's a pay to play provision. I'm not going to talk about that very much. This is more for the investors' protection. If there's a minority investor that the majority is concerned is not going to invest in a future round, they may want to force them to or convert them into common or some less preferred. So that's what pay to play is. Redemption also is not super common. And it's because it doesn't really help a lot. Redemption says you will buy my shares after 5 years if nothing else has happened. You haven't sold the company, you haven't gone public. I can force you to buy my shares back. In what situation would that ever come up? That's kind of the problem. Like, at what point does the company have the money to buy back its Series A, but hasn't gone public and hasn't exited? You're kind of just limping along, and you may not have the money at that point anyway. If you do, you probably don't want to use it for this. It's not a good idea. So it's not something I've seen ever actually get used in practice. So I think people have kind of walked away from using this. We got 9 minutes left. I'll just kind of, I guess, pause here and say there are these other documents that I talked about before. Stock purchase agreement, again, sets out the logistics. Investor rights agreement sets out a number of rights. Registration rights is one of them. Right to participate in future rounds is another one. There are sometimes controls built into the investor rights agreement, like the protective provision that says that you will not do certain things without the board member of the Series A approving them. The right of first refusal and co-sale agreement, again, is controls. If you're an investor, let's say you put $1 million into a company that's got a $5 million valuation, you own 1/6 of it on a post-money basis. So that means the founders own 5/6. What happens if they want to sell? Well, you may want the right to buy their shares from them. That's the right of first refusal part. Or you may want to sell along with them if they're going to be selling at a high valuation. So investors ask for this right of first refusal and co-sale agreement. I have never seen it actually used. I see it invoked and I see people negotiate around it, and it is relevant. But at the end of the day, it acts essentially as a prevention for the founders to sell their stock in a way that's not involving the venture capitalists. Voting agreement, again, is something that sets it determines who's on the board. If you have a number of Series A investors that invested in you, there was a whole syndication. One of those probably acted as the lead, and that lead is probably the one that wants to appoint the Series A director, but they may not actually have a majority of the Series A. The voting agreement is what all the shareholders agree to appoint that lead investor as person to the board. And that's the way that works. And that voting agreement will also say who else is going to be on the board representing the common or the founders.